Hi, good day. Allow me to formally introduce myself. I am Clive Cabernet, and I am a father of five lovely children. Most people have known me as a tax advisor. I am a CRA registered tax e-filer since 2005 and have been servicing to more than 1,000 clients every year. So, in total, I have over 20 years of accumulative experience in both corporate accounting, taxation, and of course, personal finance. Why am I capable of offering the best plans for my clients? Simply because I am a broker. Just for your awareness, there are two types of advisors in the market, a broker and a sales agent. Sales agents are only affiliated with one company, so the products and services they can offer are limited to what their company can offer. They lack the flexibility on product options, while brokers are more diverse and have wider approach in our services. Our brokerage is actually affiliated with 16 investment companies. So meeting with me is actually equivalent to meeting 16 different sales agents. Plus, the added advantage of being my client, I can also incorporate effective tax planning along with the products and services that I offer. Our topic for today is all about effective financial planning. With so many conflicting opinions from different advisors, different banks, different insurance agents, sometimes it becomes too confusing to the client in choosing as to what is really the better plan for me. Right? A lot of financial advisors would tell you to buy life insurance, especially if you have family members depending on you. And they will also tell you to get a good retirement plan so that in the future you will not become a burden to your family members or to your kids. And I agree with that. Life insurance and also retirement planning are very important, but sometimes the dilemma it can become too expensive. So let me show you a better alternative, universal life policy with retirement options. So what is that? It is actually a life insurance which can transform later on into a retirement pension. So just like any life insurance, the death benefit is also tax exempt, but this one has the possibility of having a lifetime pension income. And the pension income might qualify as a tax exempt. Although you will be enjoying your pension later on in life, there will still be financial benefit at your death even after retirement. So the life insurance component of the plan will always be there, either the client dies soon or the client lives longer. Okay, let's take this example. 35-year-old female client. She would most likely pay $200 in RSP or TFSA. That's for her retirement. And she would have to pay another $150 in life insurance. And if this client is homeowner, she would have to spend another $60 in mortgage insurance and then another $55 for critical illness. So for a total cost of $465 monthly. Well, the plan is really good, but the problem though, it becomes too expensive. Imagine paying over $400 on top of your mortgage, car payments, and all other expenses. So let me show you a very good alternative. Universal Life with retirement. Total cost is only $200 per month. So that will be the retirement plan. And there's no need to buy another life insurance because it is built in, and then you can use the life insurance coverage as a mortgage insurance, so no need to buy another mortgage insurance. And it also has a built in critical illness. So for a total cost of $200 monthly. Imagine that. That's around $260 of monthly savings, which the client can use as an emergency fund or vacation fund. Universal Life with retirement for the $200 monthly, the contribution period is only 20 years, not lifetime. And the life insurance coverage for this is 500,000. This 500,000 is a permanent insurance. After 20 years, the client doesn't need to pay, but the client is still insured for half million. And there's also a 25,000 critical illness. Why critical illness is really important? Because life insurance will only pay if the client dies. What if the client doesn't die? What if we got sick? So if we got sick, the problem though, our bills will continue. Who will pay the mortgage? Who will pay the car payments while we are recovering? That's why critical illness is important, because it is intended to pay for our ongoing basic expenses while we are recovering for our illness. And the unique feature of this plan, it has a retirement pension. For this particular package, it's 25,200. So that 25,200 pension, that is lifetime. Meaning, the longer the client lives, the more 25,200 she would have enjoyed every year. Average lifespan of Canadian is up to 87 years old. So if this client will live that long, then the total pension she would have enjoyed is around 500,000. And if the client will die at that age, the projected death benefit that she can leave behind to her kids is around 665,000. Imagine that. That's totally amazing. Out of your $200 contribution, the total long-term financial benefit of this plan is over $1 million. That is a testament of an effective long-term financial planning. Universal life with retirement, the good thing about this is the client doesn't need to die in order to enjoy the plan. Let's face it, if you have life insurance now, that's only for dying. If you don't die, there's no money in it. But this plan is totally unique. This is also a very good retirement plan. For now, RSP is the most popular when it comes to retirement planning. But the problem with the RSP, it is purely taxable upon withdrawal. When you withdraw, the banks will issue you a T4. So if you add more T4 when you retire, it can potentially lower your government pension. So let's compare. What if your $200 is actually invested on RSP or TFSA, not on universal life with retirement? So if the client will die young, at least with our plan, your family will receive 500,000 guaranteed. But with RSP and TFSA, it will never be 500,000, especially if you just started. Your family will receive whatever you have accumulated minus taxes, minus creditors. How about at retirement? At least our plan will have lifetime pension, meaning the longer the client lives, the more money she would have enjoyed. With RSP or TFSA, it will run out just in a few years. For $200 contribution, no, it will never provide you a lifetime income. You would have to contribute at least $500 monthly to $1,000 to assure that you're going to have more money upon retirement. How about if the client will die of old age? At least with our plan, it has an estimated of around 665,000 death benefit to your children. But with RSP or TFSA, no more death benefit. Money had run out during retirement, so there's no inheritance. So with universal life with retirement, contributions can be very flexible. If do you think $200 is more of your budget, then we can start. We can create a plan based on $50, $100, or $20, or even more like $300. So again, remember the name, Universal Life with Retirement. It is the best long-term financial planning that anyone can actually avail of. So don't miss it out. So if you want to find out more about this, please don't hesitate to reach out. Right? You can call, text, or you can also send me an email. I also want to encourage you to please check out our other videos. By clicking the descriptions below. I have a video, Financial Planning for Children, and also Introduction to Segregated Funds. All these two videos may change your lives significantly because my work is really not to sell, because my work is to truly improve people's lives one client at a time. So have a great day, and I'm looking forward to our next meeting. Bye.